If you've ever felt like investing is a never-ending race, new trends, new once-in-a-lifetime opportunities, new experts yelling different answers, here's the truth. The market isn't trying to confuse you. It's rewarding the people who can stay consistent while everyone else keeps switching beliefs. After reading The Sacred Truths of Investing, I walked away with one big idea. Wealth isn't built by collecting more opinions. It's built by anchoring yourself to principles that still work when the headlines change. Hey, I'm Dave. I help you turn powerful book insights into practical action so you can build a stronger money mindset, invest with more clarity, and avoid the expensive emotional mistakes most people repeat for years. If you want long-term growth with less stress, you're in the right place. Now, let's talk about why sacred truths is such a useful concept. In investing, everything competes for your attention. The newest thing always feels urgent, exciting, and obvious. And that's where people get trapped. They keep upgrading their strategy not because they found something better, but because they got scared they were missing out. How many times have you changed your investing approach in the past 12 months? And be honest, was it because you improved your process? Here's a simple reminder that hit me hard. Remember SPACs? They were everywhere. People acted like they were the shortcut to wealth, and then reality arrived. That one example matters because it shows the pattern. Fads are loud. Timeless principles are quiet. And if you let loudness guide your strategy, you'll keep resetting your progress. What I love about this book's approach is that it draws a line between two things. One, the core principles that don't change. Two, the world and the companies that do change. Back in 2007, AI was mostly a lab conversation. Social media was early. Facebook was still competing with MySpace. Then came the Great Recession. Then came the pandemic and remote work. So yes, examples evolve, industries evolve, and new winners appear. But the underlying game stays the same. Find real growth, manage your behavior, and stay in long enough for compounding to work. And this is where Chapter 1 sets a foundation that most people skip. One of the least sexy truths I took from the book is also one of the most important. Successful investing requires optimism. Not motivational optimism, strategic optimism. Because even the best growth stories don't rise in a straight line. Great stocks can be brutally volatile. And volatility isn't just a math concept, it's a psychological test. A real example in the book is NVIDIA. Even with NVIDIA becoming central to the AI boom, there was a period from November 2021 to September 2022 when the stock dropped by nearly 2/3. If you held something you believed in, and it fell that much, what would you do? Would you hold your plan? Or would you start hunting for a news story that feels safer? That's why this chapter isn't about stock picking yet. It's about identity. Most investors don't lose because they pick one bad stock. They lose because they become a different person under pressure. They turn into the version of themselves that chases, panics, or freezes. So here's the sacred truths lens I want you to adopt today. When the market offers you a new narrative, don't ask, "Is this exciting?" Ask, "Is this consistent with principles that survive market cycles?" Because your long-term results will come less from what you discover and more from what you can stick with when discomfort arrives. If optimism is a strategic advantage and consistency is the real edge, then we need to build the foundation that makes optimism usable instead of emotional. We're going to go deeper into that foundation, what it looks like to stay invested through ugly periods. Here's the trap. Most people think investing is about finding the right stocks. But after reading this book, I realized the deeper truth. Your biggest edge isn't your watch list. It's your ability to stay in the game when staying feels irrational. Because the market doesn't defeat you when things are calm. It defeats you when your emotions get a microphone. When prices drop fast, what shows up first for you? Curiosity or fear? And if fear shows up, what do you normally do? Sell? Wait for clarity? Or start hunting for a totally different strategy? This is where the foundation gets real. Optimism is not positive thinking. It's a decision to keep participating in the future, especially when the present looks ugly. And history is basically one long argument for that idea. There was a huge academic project that tracked how markets performed over the entire 20th century, 1900 to 2000, across 16 different countries. Think about that timeline for a second. 2 world wars, a Great Depression, inflation shocks, political collapse, entire cities destroyed, economies forced to rebuild from rubble. If there was ever a period where you'd feel justified saying, "I'm out, this is too dangerous," it was that century. Yet the shocking lesson was, investors who stayed invested long-term were rewarded, even in places that were devastated by World War II, like Germany and Japan, where the world literally looked uninvestable for a time. That's not a motivational poster. That's a brutal historical reality. The future keeps arriving, whether you participate or not. So ask yourself this: if you could survive that century as an investor, what does that say about the kinds of headlines we panic over today? This is where the mindset piece becomes practical. Most people confuse pessimism with intelligence. They think, if I expect the worst, I'm being responsible. But what pessimism often does is create inaction. Then inaction becomes a habit, and that habit becomes a financial identity. One story in the book made this painfully clear to me. There was a guy, Gary Alexander, who spent about 25 years as a permanent bear, always expecting the next crash, always preparing for disaster. And to be fair, sometimes reality seemed to support him. Stagflation, the 1987 crash. The world looked scary. But then the market recovered, climbed to new highs within a couple of years, and something snapped. He finally stopped being a perma-bear and turned into a perma-bull. And he admitted something that should wake up every investor. As a perma-bear, his net worth was stuck below zero. Becoming a perma-bull is what made him well off. That's not just about returns, that's about life trajectory. Because pessimism can become a personality. And once it becomes your personality, you start needing bad news to feel right. You start building your self-worth around being the person who saw it coming. But the market doesn't pay you for being right emotionally. It pays you for being invested intelligently. Now, this is important. Optimism without thinking is not the goal. Blind optimism becomes delusion. So what kind of optimism actually works? The book points to optimism that's active. You keep looking for opportunity. You keep taking calculated risk. You keep making decisions based on evidence, not headlines. And there's a reason that works. Sentiment can create momentum. When people feel confident, they invest. When they invest, businesses grow. When businesses grow, markets rise. That reinforces confidence. It becomes a feedback loop. Right now, are you participating in that loop? Or watching it from the sidelines waiting for the perfect moment? Because waiting for perfect safety is usually just fear disguised as patience. And this is the foundation you need before we even talk about growth stocks. You must train yourself to stay engaged through discomfort without turning your brain off. That's the difference between optimism as a strategy and optimism as a mood. Now here's the next step. If optimism can drive profits, we need a filter, because not every optimistic story is true, and not every rally is sustainable. We're going to separate productive optimism from hype, and expose how pessimism quietly destroys returns, even for people who believe they're being careful. So the real skill isn't be optimistic. The real skill is be optimistic without being naive. Because markets don't just move on facts. They move on human emotion, sometimes rational, sometimes not. Have you ever looked back at a trade and thought, I didn't buy or sell because of evidence, I did it because of fear, hype, or the vibe? That's exactly the line we have to draw in this chapter. Productive optimism versus delusion. Here's what I learned. The market can act like it has two brains. One brain is fundamentals, earnings, cash flow, margins, balance sheets. The other brain is pure emotion, panic, euphoria, narratives, tribal behavior. And those two brains don't always agree. In fact, the market can believe things that simply aren't true, like a mass hallucination. The book uses a wild word for this. It compares market behavior to schizophrenia. specifically the idea of delusions, believing things that are not real. And it points out meme stocks as an obvious example of that dynamic. So what does that mean for you? It means even a great company can get crushed in the short term, not because the business is broken, but because emotion takes over the tape. And it also means a terrible company can temporarily soar. Productive optimism is not, everything will go up forever. Productive optimism is, reality wins over time, and I will stay engaged long enough to let that happen, while protecting myself from the market's mood swings. Let me make it extremely relatable. Imagine you're holding a real business you believe in. Then the stock drops hard. Your brain searches for a reason, and the internet supplies one instantly. Recession is coming. The Fed will kill growth. This sector is dead. This time is different. And that leads us to the most expensive delusion of all, believing forecasts are safety. Because forecasts feel like certainty, and certainty feels like control. But here's the problem. Economic forecasts can push you into the exact behavior that destroys returns, getting out, staying out, and missing the recovery. There's a section in the book that goes straight at this. It says a lot rides on forecasts. Businesses use them, investors use them, but economists never, sometimes it seems never, ever get it right. Then it gives a recent, very specific example. From 2021 to 2023, after inflation surged and rates rose, recession fear exploded. The media's reporting on a recession increased tenfold from Q4 2021 through Q2 2023, and economists were nearly unanimous. The Conference Board even reported in February 2023 that the likelihood of a recession was near 99% over the next 12 months. Yet more than a year later, as of the book's writing, there still wasn't a recession. If you listened to the fear and hid in 2-year Treasury notes at the start of 2021, you'd have locked in a tiny yield, 0.13% at the time. Over 2021 to 2023, the book estimates the total return for those 2-year notes around 0.26% plus some compounding, versus stocks returning 29.1% total return, with dividends reinvested. And it puts a number on the opportunity cost. For a $1 million portfolio, nearly $300,000. Let me ask you something uncomfortable. How much money have you lost? Not from a bad stock, but from staying safe too long. This is why negative sentiment is so dangerous. It can become self-fulfilling. The book reminds us that the 1929 market crash and the Great Depression were separate events, and that panic helped trigger bank runs and failures. That's why FDR's line still matters. The only thing we have to fear is fear itself. So here's the sacred truth I'm pulling out for you. The enemy is not volatility. The enemy is sentiment-driven decision-making. And this is where productive optimism becomes a filter. 1. I respect fundamentals because reality pays. 2. I respect emotion because the market is human. 3. I don't outsource my decisions to forecasts because forecasts often turn fear into logic. Now, if forecasts and macro noise can sabotage even smart investors, the next question is, where should we actually place our focus? Now we'll shift from the noise to the playing field itself. Why the US market is described as an oasis, and how thinking clearly about the environment helps you stay optimistic without drifting into delusion. The United States functions like an oasis for investors, not because it's always calm, but because it keeps regenerating growth. When you invest, are you actually betting on daily headlines, or are you betting on an engine that keeps producing new winners over decades? Here's the core idea. The US economy isn't just big, it's designed to keep driving increases in GDP that companies can capitalize on. And that growth doesn't magically appear. It starts with research and development, then gets turned into real-world output through capital expenditures, which feed earnings, and earnings feed share prices. So instead of getting hypnotized by macro noise, I started focusing on what actually keeps the engine running. 1. A culture that rewards entrepreneurship. This isn't just nice branding. It's a competitive advantage. The system constantly produces new companies, new products, new business models, meaning your opportunity set doesn't shrink, it refreshes. 2.50 states competing like 50 mini-labs. That state-by-state competition is another hidden advantage. Different policies, different incentives, different business hubs. It's like having multiple experiments running at the same time. 3. A mechanism for absorbing global talent. This one is huge. When a country can consistently assimilate talent from other places, it compounds innovation the way a portfolio compounds returns. The chapter then hits you with something I think every investor needs to hear. This economic primacy has always had challengers, and the world has repeatedly underestimated how resilient this engine is. A fascinating example. Nobel Prize-winning economist Paul Samuelson once suggested the USSR could reach parity with the United States in gross national product, now GDP, by the late 1980s or late 1990s. But then you get this on-the-ground reality check. A visit to Russia in 1985 revealed a society pouring resources into the military while ordinary citizens lacked basic consumer prosperity. And even something like a faded pair of US-made blue jeans could cost $100. That contrast matters because it shows why surface-level macro narratives can mislead you. Real wealth creation requires systems that convert innovation into daily life and into profits. Now let's zoom out with some numbers that slapped me awake. Investment and market scale. The US share of global stock market value is described as massive. With about 4% of the world's population, the US represents 43% of global stock market value. It also notes comparisons like the NYSE being more valuable than the next 4 largest stock markets outside the US, and NASDAQ more valuable than the next 3 outside the US. Innovation into earnings. Intellectual property-intensive industries account for 41% of US economic output. U.S. non-farm business capital spending is cited at $1.7 trillion, 2020 census reference, and the chapter links CapEx to earnings growth and stock price growth. And then there's the cash reality of owning businesses. Dividend and interest wealth streams. In 2023, S&P 500 companies paid $580.2 billion in dividends, up from $552.4 billion in the prior comparable period. The chapter also highlights the scale of bonds issued by U.S. companies and frames the combined dividends plus interest stream as enormous. If you knew an economic system consistently produced new innovation, new companies, and trillions in investor cash flows, would you still let one scary quarter convince you it's over? This is the chapter's emotional punch. The U.S. advantage is not that it avoids problems, it's that the engine is regenerative. So yes, markets get messy. Yes, there are cycles, but you're not investing in perfect weather. You're investing in a machine that keeps inventing umbrellas. Now that we've grounded the playing field, why this oasis keeps producing opportunity, the next question becomes the one you actually care about. How do you pick the right growth stocks inside that oasis? Here's the blunt truth. You don't need 500 indicators. You need a small set of signals that repeatedly show up in growth stocks before the crowd fully recognizes them. And the big insight I took from this part of the book is simple. The edge isn't fundamentals or quant. It's what happens when you combine both into one consistent process. When you look at a stock today, what do you rely on more? Stories or numbers? Because stories feel exciting, but numbers are what keep you out of fantasy. Here's the framework in one sentence. Look for fundamentally superior companies, then use quantitative risk/reward signals to filter for stocks that can deliver outsized returns. Let's break that down into the exact fundamentals pillars this framework cares about, so you can think clearly without drowning in jargon. This section is literally organized around these fundamentals: sales growth, operating margins and operating earnings growth, cash flow, earnings momentum, including analyst revisions and surprises, and return on equity. 1. Sales growth. Sales growth is the top of the funnel. If revenue isn't expanding, you're asking for miracles later. For a true growth stock, sales growth is the engine that gives everything else permission to improve. If a company's big vision is real, shouldn't you see that showing up in revenue? 2. Profitability that proves the business is real. This is where a lot of people get tricked. They fall in love with revenue growth, but ignore whether the company can actually turn that growth into profits. That's why this framework emphasizes operating margin and operating earnings growth. because strong margins signal pricing power, efficiency, and a business model that can scale. Simple way to think about it. Revenue says, people want this. Margins say, and the company can monetize it. 3. Cash flow. Cash flow is the lie detector. Companies can tell stories in earnings, but cash flow forces honesty. If the business is truly strong, cash flow tends to show it. So when you hear a company say, "We're investing aggressively," you don't just nod. You check whether cash flow supports that narrative. 4. Earnings momentum. Revisions plus surprises. This is where the framework gets practical about how markets actually move. Stocks don't just rise because a company is good. They rise when expectations are forced to move higher. And two things often drive that: analysts revising estimates upward, and the company delivering earnings surprises. If Wall Street is slowly realizing a company is stronger than expected, would you rather be early, or would you rather buy after the price already reflects it? 5. Return on equity. Return on equity is a clean signal for quality, how effectively the company uses shareholder capital to generate profits. When ROE is strong, it's often telling you the business has a durable advantage, or at least excellent execution. Now, fundamentals tell you what a company is, but quant tells you something different: how the stock behaves relative to risk and the market. This framework has a North Star concept: alpha, returns that are uncorrelated with the market and can deliver outsized performance. And it pairs that reward lens with risk measurement, standard deviation, because big winners can be volatile, but you still need a disciplined way to judge the ride you're taking. So instead of pretending volatility won't happen, you plan for it, while still targeting the kinds of stocks capable of exceptional returns. And here's the proof of life detail that made this feel concrete to me. The approach is explicitly described as blending quantitative risk/reward indicators with fundamental traits like exceptional profit margins, excellent earnings growth, and reasonable price/earnings ratios. It also emphasizes that combining these disciplines is uncommon, and that the details of measuring reward and risk matter. When you do this well, you can identify growth stocks before they're widely recognized. Names like Eli Lilly, Novo Nordisk, and Nvidia are pointed to as examples of that kind of early identification. So here's the key question: are you trying to predict the next hot thing? Or are you building a repeatable process that keeps finding strength before it becomes obvious? Because the goal isn't one lucky hit. The goal is a machine. Now that we've built the framework, what to look for in a growth stock and how to filter it through risk/reward, the next chapter answers the question everyone asks right after: where do I actually look for these opportunities in the real world? Now we'll move from framework to hunting grounds, specific places and categories where growth tends to show up, and how to search with clarity instead of chasing hype. Most investors lose before they even begin, because they search for growth in the wrong places. They wait until a stock is already famous, already trending, already priced like perfection, and then they call it investing. What I learned here is the opposite approach. You don't chase what's loud. You build a method for consistently discovering growth before the crowd can't stop talking about it. If you only hear about a great stock after it's everywhere, are you investing? Or are you arriving late to a party where the best food is already gone? This chapter is really about mapping your hunting grounds. It highlights specific places to look, and it organizes them around a few big ideas. 1. The 100,000% club mindset. Exceptional winners exist. The book points to the reality that a small number of stocks can generate life-changing returns. So the mission is to find those rare names by applying a disciplined process, not by guessing. Now, the phrase 100,000% club is provocative, but the concept is straightforward. A tiny fraction of companies become compounding monsters. If you want extraordinary outcomes, you need a search strategy designed for extraordinary companies. 2. Start where innovation becomes revenue. Remember Chapter 4's Oasis idea. The US keeps generating new companies and new industries. Now we turn that into action. Hunt where innovation is turning into real earnings power. This section emphasizes looking for fast-growing companies with strong fundamentals, especially the kinds of companies that combine high growth with strong profitability signals. Because the truth is, great growth stocks usually show their strength in the numbers before the public story feels safe. When you see a new industry forming, do you wait for the story to feel proven, or do you look for the financial signals that prove the story is already working? 3. Use specific hunting channels, not random browsing. This chapter is practical. It's not telling you to scroll social media until you feel inspired. It focuses on structured sources and categories, places where you can repeatedly screen for candidates, then apply your framework from Chapter 5. Think of it like this. If you're a hunter, you don't wander randomly and hope a deer appears. You learn the terrain. You learn patterns. You return to the places where signs appear. So the real skill isn't finding a stock. The skill is building a repeatable pipeline. Identify candidates from the right hunting grounds, validate them with fundamentals, sales growth, margins, cash flow, earnings momentum, ROE, and filter risk/reward so you're not confusing volatility with value. 4. The psychological hunting rule. Avoid the hype zone. Even without listing every possible category on screen, the message here is clear. By the time something becomes a cultural obsession, the easy money is often gone, and the risk of overpaying rises. So you want to search where growth is real but not fully recognized. Fundamentals are improving. Expectations are still catching up. Right now, are you building a pipeline, or are you waiting for someone to hand you a hot pick? Because if you want the results of an investor, you need the habits of an investor. And this is where the book quietly ties everything together. Chapter 1 gave you the lens. Stop chasing stories. Anchor to truths. Chapter 2 built the foundation. Optimism as a strategic advantage. Chapter 3 taught the filter. Avoid forecast-driven fear and sentiment delusions. Chapter 4 clarified the playing field. The U.S. as an oasis for compounding opportunity. Chapter 5 built the playbook. Fundamentals plus quant risk/reward into one repeatable process. And Chapter 6 turns it into action. Where to look and how to search with intention. If you want a clear, structured way to think about growth investing without getting hypnotized by headlines, go read The Sacred Truths of Investing. Don't just read it once. Read it with a notebook and build your own truths list as you go. And if you enjoyed this breakdown, check out the other videos on this channel, because I'm building a full library that helps you master both sides of the game, the money mechanics and the mindset mechanics. Because in the end, investing isn't just about making money. It's about becoming the kind of person who can hold on to a great decision long enough for it to change your life.